Hello and welcome back. In this video we will start looking at income tax and FICA. So to begin with, what I really want to do is talk about some of the terminology. There's a few questions that just ask you to calculate your income, your adjusted gross income, and your taxable income. So to begin with, your gross income is just going to be the total of all the money that you earned over the course of a year. It could be from your wages or your salary, and it could be from things like if you have invested money and you earned money in interest, say from a savings account, or you invested money in the stock market and you earned money like that. Essentially all the money that you make goes into your gross income. However, your adjusted gross income, not all of your income is going to be essentially taxable for that year. So essentially what you do is you take all the money that you earned, your gross income, and we are going to subtract some adjustments from it. And typically the idea is that if you put money into a retirement account, into a retirement plan, that money you don't pay taxes on as you put it into your retirement plan. Later, when your retirement plan earns interest, it will be taxed then. So in particular, like with retirement plans, you don't want to be taxed twice on it when you take the money and put it into the account, and when you take the money out of the account later. So this is just to prevent you from getting taxed twice on the same money. So you just take all of your income, and we'll subtract out our adjustments. And then finally, we have our taxable income. So we have seen, okay, so you have your total, your gross income, your total income for the year. Some of it won't be taxed right away, so we subtract that out, and we have our adjusted gross income. And then finally, there are a few other things that we need to subtract out because you don't get taxed on everything. The first thing is the exemptions. So everyone gets an exemption for a certain amount of money. This is a flat rate across the entire U.S., and I think it's something about $4,000. So $4,000 a year you don't get taxed on. So there's just no taxes there, which is quite nice. And it just means that, if you're earning very little, that $4,000 that you're not getting taxed on can go quite a ways. So everyone gets that fixed exemption. The other thing that you can get taken out of your money so that you don't have to pay taxes on it are what are called deductions. And there are two choices for your deduction. You can either choose the standard deduction that everyone gets as an option, and that's something about $6,000. So you can just choose to either not pay taxes on $6,000 of your dollars, or if your total deductions for the year, and I'll go through what those might be, if those add up to more than that $6,000, you choose the second option. So individual deductions can be things like donations to charities. You won't pay taxes on that, and sometimes if you're paying state taxes, the federal government will say, okay, since you've paid that in taxes, we will deduct that from your total that you have to pay taxes on. So you don't have to pay essentially state taxes and then the federal taxes on top of that. So depending on how many deductions you have, though, sometimes your total deductions will be bigger than the standard deduction, so you should choose that one. We want as big of deduction as possible. Or sometimes if you haven't, made thousands of dollars of donations to charities, sometimes the standard deduction is just better. And everyone has the option to just take the standard deduction. So let's go through an example where we calculate the gross income, just total all the money, find our adjusted gross income. So we'll take all the money that we earned, but some of it won't be taxable. And then we'll go through and we'll find our taxable income. So at the end, this is the money that the government will say, okay, this is how we will calculate your taxes. These normally have a lot of information, but all it is just identifying what's what. So let's read through this first. A man is single and earned $35,900 in wages. Okay, so he earned a little bit of money. That should go to his income. He received $420 in interest from a savings account. Ooh, okay, so he also earned a little bit of money that year. So this is also going to his income. He contributed $500 to a tax-deferred retirement plan. Okay, so that money he won't have to pay taxes on right now. So this would go to his adjusted gross income. And then he received $3,400 in deductions from charitable donations. Okay, so this would go to his deductions. So let's go through and calculate each one of these. The questions on the homework will come with this big table. It's filled with a lot of information, but we won't need all of it. So his gross income. How much did he earn throughout the year? Well, he made $35,900 in wages. So $35,900, and this is in wages. And he also earned $420 in interest. And then this is in interest from a savings plan. So this is how much money he earned throughout the year. And if we come over to Desmos, we can see 35,900 plus the 420 gives us $36,320. $320. So this is how much this guy earned this year. So that's just this total gross income. However, he contributed to a tax-deferred retirement plan. So that means that his adjusted gross income, some of that money he's not going to pay taxes on right now. He will when he starts drawing from his retirement plan, but maybe that's a long ways into the future. For the moment, his gross income is $36,000, but his adjusted gross income is going to be a little bit less than that. We get to take his gross income, the gross income, and we get to subtract that money that he put into the tax-deferred retirement plan. So we come back to Desmos. We can take, our previous answer, this is 36,320, and we get to subtract the $500 that he put away, and that's going to be 35,820. Cool. So this is his adjusted gross income. And then the final thing is we want the taxable income. So we want to know how much money is he actually going to have to pay taxes on. And what we do is we're going to take his adjusted gross income, and we're going to subtract the exemptions. And we're also going to subtract the deductions. Okay. So the exemptions is always easy. It's just a fixed amount. So I'll highlight this in red. So everyone gets $4,050 in exemptions. So they don't have to pay taxes on $4,000 every year. And this is per person. He's single, so we don't have to worry about other people. This is just going to be per one person. So just that $4,000 Next up, we have the deductions. And again, there are options for deductions. You can either choose the standard deduction, or you can choose the deductions that you accrued over the course of a year. So the standard deduction is $6,350, but this guy has $3,040 in deductions because he made some donations throughout the year. So which is better, deducting $6,000 from your taxable income or deducting $3,000 from your taxable income? The clear answer is going to be the standard deduction, because we're not going to have to pay taxes on $6,000 as opposed to paying taxes as opposed to not paying taxes on $3,000. We want as low a taxable income as we can, because that means that we're going to pay fewer taxes. We're going to pay less taxes. So we want the standard deduction because we get to deduct more than the donations that he made to charity. So the deductions that he would choose are going to be the $6,350. And this gives us a total, so we can come back to Desmos. So we take our adjusted gross income, and we will subtract our exemptions, the $4,050, and then we'll also subtract our deductions, which is going to be the $6,350, and that gives us $25,420. So, after all is said and done, when this guy looks up how much taxes he'll have to pay, this is going to be the number. This is going to be his taxable income. This is the money that he will have to pay taxes on after he took out his exemptions, his deductions, and any money that he put into tax deferred plans. And I'll continue in the next video.